Honorable Minister, Governor, guests, and fellow participants. I'm very honored to be here. I thank you all for having me, and like you, I enjoy a break out of the office, and this gives us a wonderful opportunity to do that. Livingston is a beautiful place. Those of us that were here yesterday afternoon got to experience one of the phenomena of this part of the country. It gets very hot. But this morning it was beautifully nice and cool, and those of you that were like me and able to go over and see the falls first thing this morning, it was beautiful. So I encourage you to do that. As my good and old friend from Nairobi said, I'm Terry Blagg. I'm from the United States Department of Treasury, Office of Technical Assistance. I'm currently serving as an advisor to the Bank of Zambia in the area of supervision for both commercial banks and the non-bank financial institutions. Also, as my friend from Nairobi mentioned, I began my career in banking supervision over 40 years ago when I joined the Office of the Comptroller of the Currency. The Office of the Comptroller of the Currency is the regulatory authority for the nationally licensed banks in the United States. I was with the Office of the Comptroller of the Currency for 31 years until the end of 1997. At that time, and I began an 11-year career to date advising regulatory authorities in developing countries in the area of banking supervision. So why have I said this? Because you can just take one look at me and see I'm not a young man. I gave you that background as a means of saying that I have observed in the United States banking industry its passage through several financial crises. But that observation on my part and work on my part was from a banking regulator's perspective, not from a monetary policy nor a financial crisis management perspective. And that's my caveat to you, that I'm a banking regulator, not an economist. We're now faced with yet another crisis in the United States. It's called the subprime real estate mortgage crisis, and there's a debate on this, but some generally say it started about 13 months ago. It's now moved into a far more serious phase, and it has implications worldwide. This morning I've been asked to speak to you about how will Africa experience the credit crunch that's resulting from this crisis. So I'd like to talk to you a little bit about what the problem is as I see it, what we're talking about, and how did it begin. Between 2002 and 2006, household debt or household borrowing in the United States grew at an average annual rate of 11%. This far outpaced overall economic growth. Much of this debt was consumer debt in the form of subprime borrowing for the purchase of real estate. Now, most of us are very much familiar with the term subprime as it relates to the extension of credit to a business borrower. And that means that it's a loan that's made at a rate below prime, or what the lending institution's reference rate for commercial loans would be. With regards to the subprime problem that we're talking about, it means that credit was extended to a borrower who had a weak credit history. In other words, funds were advanced to an undeserving borrower. Often these advances were in amounts well beyond the borrower's ability to repay. Simply stated, these were poorly underwritten loans for the purchase of homes. Lenders seem to have forgotten or failed to follow one or more of the 5 C's of credit that is needed for an individual to obtain credit. One is character. What's the integrity of your borrower? 2 is capacity. This is one of the 5 C's that I see where the perhaps the biggest fault was made. By capacity, what is meant was, does the borrower have sufficient cash flow to service the obligation? And when we talk about servicing the obligation, we're talking about not only today, but to maturity, to full repayment. The third C is collateral, another area that was kind of set aside. Yes, collateral was taken. We talked about these were real estate mortgages, so the implication is, and correctly so, that there was collateral taken in the form of a mortgage on the individual's real estate that they purchased. The fourth C is capital. What's the individual's net worth? How well off are they? And the fifth C is conditions, both of the borrower and of the overall economy. Loans were written at the beginning of this crisis, or what brought us into the crisis, under the following, general conditions. The first one, and this was very common, and you saw it in many of the problem loans that have gone sour, that have resulted in their problem. There was 100% financing. The bankers in the room should quickly see that if the borrower has no equity in the loan, has no interest in the loan, who's really taking the risk? The bank is solely. There was one, not only did they finance 100% of the purchase price, but many times the origination fees and the filing fees and so on that were associated with the loan were also included in the principal of the loan. The loans were made at adjustable rates. I'm not sure many of us here in Africa are lending on an adjustable rate basis, but these were all written on adjustable rates, and they were generally had a teaser rate to begin with. By a teaser rate, and I know that's not a very technical term, but that's a rate that is well below what a normal market rate should be for that type of lending. In other words, it's an enticement. They're basically asking the borrower to come in and borrow money as opposed to waiting for him to come in. Another thing that they did that's for your bankers, I hope you see the fallacy in this. They did no income verification. Remember, we said one of the C's was the capacity, the ability of the borrower to repay the loan. Well, if you don't verify their income, that's extremely difficult to analyze, to assess. Nor did they verify employment. Now remember, these are consumer loans. Consumers have only one source of income mainly, and that's from their work. Well, if you don't verify that they work someplace and what their actual income is, you've really taken on a lot of risk. So why did they do this? Why did the lenders make these, what I call, basic mistakes? What was their rationale, if you please, for doing this? One was, keep in mind, they were getting origination fees. For every loan they made a little 1 or 1.5 points up front. That just goes right in their pocket. Secondly, they did not intend to keep these loans on their books. They would sell them off, and we'll talk about this in a little bit. However, they would retain the servicing rights. In other words, as the borrower made his monthly payments, he would continue to make them to the lender, who would then pass them on to the ultimate owner of the loan. And they charged a fee for that from the purchaser. So they would be getting servicing fees. And then the third of mine, I'm sure there may be some other reasons why they did this, was the false sense of security that we in the United States have had, and I think it's not unique to the United States, but it's a phenomenon known as that housing prices will always go up. You know, there's an old saying that why do you buy real estate? Why is real estate a good investment? It's because they're not making any more. There's only so much of it. So prices always go up. Well, as we'll see, that's not always true. Well then, as I say, reality set in. Remember I said these loans were adjustable rate mortgages. And as you know, an adjustable rate mortgage, you have a rate for a certain period. At the end of that period, it will adjust. And we can discuss at another time the factors behind how you determine pricing so you do that. But anyway, when the initial interest rate periods expired and the interest rates on the loans adjusted to higher levels, which they will always do, no surprise, many borrowers found themselves unable to now make the payments. They couldn't service the debts anymore. And as you might guess, if you can't service the debt, that results in a default, which in turn triggered foreclosures. Unfortunately, now we're talking about the United States real estate lending market. Well, the real estate market was experiencing what I call a cooling off period following a length of time where there had been steady increases in home prices. However, in this cooling off period, real estate values were falling. So as you would guess, if the loan was made without any margin, in other words, there was 100% financing, and the value of the collateral has fallen, okay, there's a decline in the value of the real estate, the lender now, who goes to foreclose, does not receive sufficient funds from the sale of the collateral to pay off the outstanding balance on the loan, which results in a loss. That loss being the difference between the value of the collateral and the outstanding value of the loan. Now, if that were the end of it, we probably wouldn't have this crisis, but that's the basis for it. And it's not that simple. So what really happened? Okay, the institutions that made these bad loans, like I said, they never intended to have them on their books. They, the lenders, who are the commercial banks and the loan brokers, packaged and sold these loans to Freddie Mac and Ginnie Mae and the investment banks that my colleague over here referred to. The names of these investment banks, or some of them anyway, have become very familiar to you recently because of their exposure in the international press. Bear Stearns, Lehman Brothers, and Merrill Lynch. The sale of the poorly underwritten loans, that got these bad assets, as we'll call them, out of the banking system, which is regulated and supervised by the banking regulators who closely monitor them. Now, I was a banking regulator, so this is why I think this is very key, that they didn't want to keep them there. And I think most of you from the central banks, you regulate the banks. However, what happened was these bad assets now got on the books of the investment banks. Unfortunately, in Africa, we don't have too many of these. I think maybe one or two at most. Now, in the United States, the investment banks are regulated by the Securities and Exchange Commission. Now, their monitoring standards and procedures are based on different fundamentals than those of the supervisors of commercial banks. The basis for this is the commercial banks take deposits, and as all regulators, the United States is no different, the regulator's primary concern is for the depositor. So as a banking supervisor regulator, you're concerned about the depositor, so you monitor much closer. The investment banks don't really have any depositors. And so therefore, there's different types of, the SEC is more concerned about disclosure. Okay, but now the investment bankers have these, that's fine. They did what investment banks are supposed to do. They went about packaging and restructuring, again, these loans into a product for their customers who are institutional investors. Now, the investment banks, what they did is they created collateralized mortgages or collateralized debt obligations, which is a bond secured by the cash flow from the pool of mortgages that are set up beside this. Now, these collateralized mortgage obligations were structured in a variety of ways based on the buyer's needs and wants. Some of the tranches were short-term, some were mid-term, and some were long-term. Now, the investment bankers aren't totally stupid. They knew that the underlying collateral, these products that they had, weren't really the best thing. So in order to sell these to the institutional investors, who are banks, insurance companies, retirement and pension funds, hedge funds, and mutual funds, the investment bankers sought and obtained insurance as guarantee for payment against the defaults. American International Group, AIG, which is another name that has become received much coverage in the international press lately, and others sold credit debt swaps to back or to guarantee these collateralized mortgage obligations. Now, since the institutional investors are generally international entities, or there are several of them, you can now see how consumer debt in the form of poorly underwritten residential real estate loans, and there were many of them, that went bad, have resulted in a credit problems that reverberated around the globe. Now, in response to this crisis, lending practices have tightened. Initial efforts by the U.S. Treasury and the Federal Reserve System in the United States have done little to unfreeze the credit markets. And banks remain extremely reluctant to lend right now. Mortgage lending standards in the United States have tightened extremely. As a personal example, in 2006, in 2006, I bought a piece of investment property and basically got one of these subprime loans. I mean, it was, I just signed my name and I borrowed the money. I hope I'm not embarrassed telling you this. I'm trying to refinance that loan because interest rates have come down. I'm trying to refinance. And I am observing firsthand, it's the same loan, it's the same organization. I keep telling the banking officer that I'm dealing with, you know, you already have this loan on your books. If you're going to turn it down, it's not going anyplace, you still have it. But it illustrates the unique questions that they're asking, the underwriters are now asking. For one example, this investment property is on the 7th floor of a building, and they're having trouble with flood insurance because the building's in a floodplain. I don't know how that translates anything, but my way of thinking is it's on the 7th floor. If the flood gets that high, the repayment of my loan is going to be the least of anybody's worries. But these are the things that illustrate that the pendulum has truly swung almost totally the other direction. Okay, this is Tuesday. It's last week. The U.S. government took some steps on Friday. It's obviously too soon to tell about those, or towards the end of last week, how effective they're going to be. And if you follow the U.S. markets, the markets on Friday really liked what the U.S. government had done. If you looked at the market yesterday, something happened. The world has woken up and doesn't like what the U.S. They're questioning. Let's put it that way. Bottom line is, I can't tell you if this is going to work or not. But the U.S. is taking steps. In truly, I think what it points out is that we live in a global financial market. That what happens in one place does impact, because while yesterday the Asian markets did quite well, but as the clock advanced, the European markets didn't do so well, and the U.S. market totally tanked. I think it was 3.3% down, which is not good. And I don't know how much of that was reflective of the oil prices, the increase in the oil prices. Again, I'm a banking supervisor. I'm not an economist. So as we go through the discussions this week, perhaps we can, see what a cause and effect there is. Now, one thing that was announced that raises our attention on some things was that the investment banks would be allowed to become holding companies by the Federal Reserve System in the United States. I wanted to to state what that means is, and there was some banner about, well, now the investment banks can take deposits. From my understanding, the way our banking system works, the United States banking system works, no, the investment bank will not take deposits. What it allows it to do is the investment bank will file and be licensed as a holding company. Holding companies in the United States then own banks. What that holding company can do, whether it's whatever the name of it is, Lehman Brothers Holding Company or whatever, it can then apply for a license to establish a bank. It would be a separate entity. And as you know, in the United States, we have what's called a dual banking system. Both the individual states grant licenses for banks, for entities to become banks, as does the federal government through the Office of the Comptroller of the Currency. So this investment bank will be granted a license as a holding company. It then in turn will have to establish a bank, either licensed by the state or the Office of the Comptroller of the Currency. That entity then will be a commercial bank, a deposit-taking institution. And there are some Chinese wall, there's some restrictions between how much funds can flow between the commercial bank and the holding company and then on up to the investment bank. But that's kind of what that latest innovation that has been put out. And as we go through today and then the rest of the week, we'll see how well that might work. But okay, what's the impact going to be on Africa? And I hope during our question and answer, or as we call it, the discussion session, in my mind, you will bring forth ideas too on this. But I want you to remember what Dr. Claudia was saying about the cost of borrowing. You mentioned that since Zambia does not have a credit rating, their cost is very high. I see this crisis having on Africa, that Africa will have to deal with the tightening of credit that I mentioned before, to the extent that Zambia or whoever may be seeking funds from outside entities, it's going to be tighter. Africa can also expect a reduction in the level of foreign investment as investors have become more selective. I should also mention that losses that these institutions have taken will have an impact on the volume of funds that they have available to invest, which means, again, that they'll be more selective and hopefully more risk adverse, which could result in, because you don't have a credit rating, the costs will even go higher. And then the third thing I say is what began as a subprime mortgage lending crisis has become what many are now calling the confidence crisis. I see this, the lack of confidence, as something Africa will be dealing with. The central banks, the financial institutions, and businesses may begin to question the strength of those with whom they do business. They may become more selective in choosing their financial partners. And I believe it was when I was talking to the governor, he mentioned that you individually are going to say, I know what I have on my books, and I know what my financial strength is, but I'm not so sure. Do you have any of these CMOs on your books? And because of that, there's going to be a little, if nothing else, slowdown in the flow of business. So what are the lessons learned? I think one thing I'd like to think anyway, that we, in the past at least, looked at the U.S. lending as a model. You know, we haven't always gotten it right. Like I said, I've been through several crises. The Latin America crisis, we've had an oil crisis, we've had a real estate crisis in the commercial lending area, we've had an agricultural lending crisis, but we seem to get through them. So what can we take away from this one? And I'd like to point out and stress, always remember the fundamentals of risk management. In this case, as they apply the management of credit risk. Do not chase after profits, especially when you do not have a full understanding of the risks involved. Many of these investment bankers were good at what they did, and that was to manage market risk. And they kind of forgot about the underlying credit risk that was in those products that they had bought. And third, ensure that you have sound risk management policies and procedures in place and that they're understood and followed by all. And finally, early on in my career as a banking supervisor, I was told, and I still believe it, that it is the return of the principal that is far, far more important than the return on the principal. The quest for high returns on investments pushed aside this premise. Little or no concern was given to the basic question, will I get my investment back? And I guess we'll take questions at the end, so thank you very much.